Well, ladies and gentlemen, thank you for joining us today. I'd like to explain how Liberty can benefit from this current gas boom that we described earlier in our last presentation to you. As you may be aware already, an integral part of our process is where we convert coal with water and we produce gas as an intermediate product, and then from that gas we produce fertiliser, urea in particular, and that's the basis of our project. Gas production is an essential step in our process, and we've been aware of this for some time. However, some things have changed recently. Part of our project requirement to go into commercial scale production is to produce a stable and consistent gas product. And certainly in the last few years there's been further advancements in technology and available equipment which reduces the operating cost for us producing pipeline specification gas suitable for the domestic market and also potentially suitable for the LNG industry, which is booming in Australia. Furthermore, for us, having an early gas production stage as part of our project gives us the opportunity for early cash flow, which is very important for all of us as shareholders. There's a number of other benefits too that we've identified recently, which we're now sharing with you. The cost to develop the gas plant is around $1.5 billion, which is a significant reduction on the $4 billion to develop the entire gas and fertiliser project as we'd previously scoped out. We can also see very good returns on investment from the gas plant in excess of 20% per annum. This is very important from a financing point of view because the better the returns on investment, the easier it is to finance simplistically. It's also going to take us less time and there's less risk associated with developing the gas plant first, getting into production and cash flow, and then adding our urea fertiliser project on to the existing gas production. One of the other benefits, which we've touched on in the past but we think is very important, is our project from an environmental and social point of view has a number of advantages. Now, one of those is a very small impact in terms of land footprint in the total area. So we've just got a diagram here which illustrates for about the same energy benefit as some of the other existing industry active in Queensland, we use about 2% of the land space for the same benefit. For us also, because we're looking at a 50-year project life in many of our project areas, producing the gas and then turning that into fertiliser, it's important for us to have a sustainable community. So we've been working on this for some time now and we're making rapid advances in our sustainable community development and support of sustainable communities in regional Queensland. One of the other important features of our project is we operate in a contained reservoir system. Now, what do I mean by that? Well, if you think back to traditional oil and gas, the way that industry has occurred is the oil and gas industry taps into existing oil reservoirs that are capped. They're contained, they're stored, if you like, underground. When you drill into them, you access that energy, and that's what the oil and gas industry has been built on over the last 150 years. For us, we're similar. Our coal is effectively capped or trapped, if you like, under a cap rock, similar to the oil and gas industry, and we use water and oxygen to turn that coal into gas, which then remains trapped until we extract it with the drilling, the similar sort of drilling to what the oil and gas industry uses. But the key emphasis here is it's a contained environment area and it's a very small land area. One of the other benefits that we've identified in recent months of work through the course of late last year and early this year is that we can use salt water as part of our process, and as part of the process the salt goes down but it doesn't come up. So we're looking at actually injecting saline water into the ground and we produce steam and our syngas, which then we turn into gas and fertiliser, comes out of the ground. Where does the salt go? Well, the salt basically stays trapped underground, in our case below 500 metres depth and at depths down as far as 1.5 kilometres. The good news with that salt is once it's down there it forms a saline brine, which is very heavy and it tends to sink rather than float. So this is a real opportunity for us to take saline water from near the surface of our land, put it into the ground and make sure it stays there permanently, which then of course improves the quality of soil and land in Australia. In Queensland, we have excellent infrastructure. Queensland's been well developed over the last 50 years, serviced well by railway lines, pipelines, towns, communities, etc., etc. So we're operating in a great environment. And in terms of our particular project areas, there's two that we're currently focused on to develop our initial gas plants. One's in the Denison area that we've been working on for some time now, and the other one is closer to Miles. It's called Victus. And again, as you can see from these images, the land usage is very minimal. In fact, it's fairly marginal country and it has a low economic value as it stands. So this is important in terms of developing the economic resources of Australia. We don't see any conflict potential operating in these areas as we develop our projects and communities around them moving forwards. How does it all happen? Well, we mentioned coal before, where we turn the coal effectively through a process into fertiliser. So in particular at the Denison, we have over 800 million tonnes of coal that we've announced previously. Well, what does this mean? Well, when you convert it into gas, there's a few steps involved. The first one is for every 100 million tonnes of coal that we have, we'll get about 1,000, just over 1,000 petajoules of gas in the raw syngas form, and this is the basis upon which the project is built. We can then turn that into synthetic natural gas, or more of a pipeline traditional gas, and we get a bit less gas in terms of energy, about 880 petajoules for every 100 million tonnes of coal. And then when we take that through to ammonia, we get about 30 million tonnes of ammonia, and then when we finish it off and produce our urea fertiliser, we're looking at just over 70 million tonnes of urea production per 100 million tonnes of coal. So this gives you a rough indication of the size and magnitude, especially when the entire global urea market is around 160 million tonnes a year. In terms of cost estimation, we've done a lot of work. Our focus over the last 3 years has really been on commercialising this form of unconventional gas to take it through the steps to ultimately produce fertiliser, and we've come up with some indicative numbers, and there's a number of very attractive numbers here. In terms of actually producing the gas at the wellhead, we're looking at less than $1 a gigajoule for our syngas. It's very competitive. By the time we take that through the process and turn it into an actual pipeline specification gas, we're looking at a cost estimate of something closer to $2.50 a gigajoule, which again is very attractive. And then when we take it through the steps to ammonia, we're looking at less than $100 a tonne. Ammonia typically trades around the world for around $500 to $600 a tonne. And then in the case of urea, our local cash cost of production by the time we finish the process, we're looking at around $70 a tonne. Talking to some of the farmers, especially in Queensland over the last year or two, farmers are paid upwards of $700 a tonne at times when demand is tight. In terms of our technical team, and we'll be introducing them separately soon, but we have built a very good technical team here in the company over the last few years. And these numbers that I've just quoted to you are based on a lot of work put together by some very professional people with a great knowledge base and great access to knowledge around the world. So we're looking at a situation where we've got a very large project with a small company, Liberty Resources, but that gives us very large leverage. So currently we have around 260 million shares on issue, and we're capitalised at around $15 million. So we see this as a terrific opportunity to grow a very large company from a very small base. In terms of project finance, where will the money come from? Well, we see most of the money will come from offshore. We've signed an agreement late last year with Marubeni for offtake of ammonia and urea up to 1 million tonnes per annum each. And if you reflect back on those dollars per tonne that I mentioned earlier, you'll get a sense of the size of the magnitude of that offtake arrangement, which is a 25-year duration. We also see, as does our second largest shareholder, that this is a doable deal in terms of project finance and going to the markets as we step into that capital phase after we've finished our BFS. In terms of share price, last year was a good year to put behind us, and the share price is very low by historical measures at the moment, as I'm sure you agree. So we see this as a watershed year for us and a great opportunity for investors as well as existing shareholders. And the valuation argument, just to throw some numbers at you before I wrap it up. For every share that current shareholders own in Liberty Resources, if you go through all the numbers and all the math as we have done now over the last few years, it works out that as a Liberty investor, for every share you have, you're paying about 0.16 cents a gigajoule of gas. Well, what does that mean? Because gigajoules aren't familiar to many of us. Well, a gigajoule of gas trade sales, or is transacted, if you like, bought and sold as a reserve in Queensland recently for 50 cents to $1 a gigajoule. So that gives you a sense of the upside. Another way of looking at it is for every share that you own in Liberty Resources, we're looking around 34 gigajoules per share, and reflect again on 50 cents or $1 per gigajoule for simple transactional based valuation. If you take that gas through and sell it in the domestic market at the moment, those gigajoules are selling long-term contract for between $7 and $9 a gigajoule, depending on who you talk to. And if you're talking to the LNG producers in Australia, those gigajoules of gas sell for $12 each when they're put on a boat and exported into the Asian markets. So that gives a rough indication of what we see as the opportunity here moving forwards. So we see many benefits, not just for Liberty shareholders, but for Queensland and Australia. It's very clear that gas prices are rising. There is a gas boom happening. LNG and local companies are actually short gas. They're still trying to build their gas inventory to support existing industry and new industry. The government's also aware, and we've seen this with recent commentary from both federal and state government, that there's a shortage of gas looming, and that has significant impact on our quality of life in Australia. And we see this as a great opportunity for Liberty to get its project up and running, initially based on gas, especially in our case, low-cost gas, and then ultimately, of course, low-cost fertiliser. So ladies and gentlemen, thank you very much for your time today.